All right, and we are back. This is once again Chapter 8. This is the 8th video in this series for Chapter 8, Investing. We're going to wrap everything up in this video, starting out with forget the news. It doesn't matter for average returns. You don't need to listen to the financial news to invest wisely. Most financial news stories cover a single event today, and media outlets are on to the next news story tomorrow. The news is too fast for you to take advantage of or get too worried about if you are only after average returns. If some professional money managers trade the news, that's fine, but you don't need to. The ups and downs of the financial markets are built into your average returns. As long as you stay invested during the good and bad years, you will still get an average return in the long run. It can also be challenging to hear friends, family, or salespeople talk about the high returns they're getting from their exotic investments. These investment opportunities come in several varieties: hedge funds, real estate, partnerships, commodities, penny stocks, options, cryptocurrency, etc. None are inherently wrong, but at an early point in your FI journey, you don't have enough time, education, or experience to make a wise decision regarding these types of investments. So I recommend listening to them if you are curious and learning about them if you are interested, but don't invest anything in them now. Instead, stick to your stock index and bond index portfolio. Maybe you can try some of those exotic investments with a portion of your assets in the future, but not right now. Now is the time to establish something that has a high probability of working. Remember, this is your primary plan and possibly your only plan if the accelerators don't materialize for you. We'll be talking about accelerators in Chapter 9. It is your low risk, high probability plan to achieve FI. So don't worry about all those exotic investments. Just hyper focus on your FI plan. You don't have to make many adjustments once you set up your investment income engine. All your additional focus should be on figuring out how to increase your income and decrease your expenses so you can contribute more to your investment income engine. Just let the investments take care of themselves. Okay. All right. Now we need to prepare yourself for downturns in financial markets. So average returns are not fixed returns. Hopefully you understand that through some of the different things that we've read and looked at, some of the graphs. Average returns are what you get after all the ups and downs. The reality is that the stock market is going to fluctuate. Suppose you have 100% of your investment income engine in a diversified stock index fund. In that case, occasionally you will experience a 20% drop in your current account value. That means if you have $100,000 in your account today and the market has a correction, it could decrease to $80,000 over the next 4 to 6 weeks. Once in a while, the stock market experiences a bear market when the economy is overheated, then contracts for an extended period. At that point, your account could decrease by 50%. Right? That's a gut check. Right? We don't like that, but it can happen. For example, if you have $1 million in your account and the economy contracts, the account could decrease to $500,000 over the next 3 to 6 months. It doesn't happen often, but I'm preparing you for it now. By the time your account decreases by 50%, there's nothing you can do. Do not sell. If you are contributing to your accounts, continue to do so. The economy will recover, and over time, the stock market will exceed its previous value before the decline. No, financial markets have not changed. While it is emotionally challenging to see your account decrease, what you probably experienced most recently was higher returns than the long-term average over the past few years. The correction is bringing your account value back into line with the averages. Some years you will experience a 15% or 20% return in a stock index fund, doubling your expected long-term stock index return. The negative years bring your returns back in line with the average long-term 8% to 12% return you should expect. Psychologically, this development is much more difficult to handle. It will be tough, but that is how it works when dealing with average stock index fund returns. The more bonds you allocate to your portfolio, the less of a decrease you'll experience in your account value. But in the long run, your average returns will be lower. During down markets in the accumulation phase, remember that over the long run, you have a high probability of not losing anything if you keep your money invested. The probability of losing money in the stock market over time is shown in the chart on the next page. This chart assumes dividends are reinvested. As you can see, there is an approximate 28% chance of losing money in the first year. The probability of losing money drops to about 12% after being invested to 5 years. Then it drops to just under 6% after being invested for 10 years. Suppose you're invested in a diversified stock index fund for 15 years. In that case, there is just slightly over a 1% chance you lose money. Right? The stock market tends to recover and generates positive returns over extended periods, even though short-term volatility can lead to losses. That means if you have 15 or more years left to invest, you just stay invested. Time is on your side. So once again, just looking at this, here's the probability of losing money in U.S. stock S&P 500 fund, okay, over different time frames. So the probability is 35% at the top, down to 0. If we take a lump sum of money and we put it in the market today, and then we look at our value a year from now, there is, like I said, just over a 25% chance that you'll have lost money. 5 years later, there's a just over a 10% chance that you've lost money, and over 10 years, just over a 5% chance that you'll have lost money. But if you keep money invested in the stock market, like it says right here, there's just over a 1% chance you lose money, or in other words, a 99% chance that you make money. The next chart shows that from 1942 through 2023, there's only been one 15-year rolling period in the U.S. stock market that has slightly lost money. All other 15-year rolling periods provide varying positive returns, some below the historical average and some above. Okay, so let's go ahead and take a look at this, see what we're looking at. So what we're doing is we're taking 15-year rolling averages. You can see that the data was from 1928 through 1923. You can see down here we're starting in the first point exactly is 1942, and not going back to 1923 because we needed 15 years of data to get the average. So if you counted all these dots up through 2023, there's 80 different dots, or 80 15-year periods. And so the first year, right, started in 1928 and it goes through 1942. And so that is the first 15-year period that we're seeing right here. This one right here, okay, is the next 15-year period. And what that means is it's basically measuring the year 1928 is falling off, and we're basically adding the years 1929 through 1943. Okay, and that's the next 15-year period, or the next 15-year average that we're looking at. Now, interestingly, that's the period where you were invested for 15 years and your investments just a little lost just a hair of money, just a little less than 1%. Every other period you can see is in the positive range, or above this zero mark here. We can see inflation, right? The inflation line is right here. So we want every year to at least be, or every 15-year period to be at least above that. But some years are quite high. The 15-year return was 17.5. Others, we're down here at 5% and a little bit less. The average is somewhere around here between the 8% and 10% mark, or sorry, the 8 and 12% mark. But you can see what's happening here, and how this hopefully gives you a little bit of confidence over a 15-year period invested. The chances of losing money are slim, and the chances of having a decent return are higher. Okay, so why is this important? The day-to-day fluctuations of the stock market are noisy, and the year-to-year returns can be volatile, some years dishing out large negative losses. However, historically, over longer periods, the stock market tends to consistently serve up adequate inflation-adjusted returns compared to bonds and cash. There are no guarantees. Unfortunately, there are no guarantees in the stock market, and 15 years is a long time to wait for the averages to rescue you if you are caught in a bear market on the verge of becoming FI. If the stock market experiences extreme losses during your distribution phase, your investment income engine will decrease substantially. To mitigate the impact that it has on your lifestyle, here are some things you can do to prepare. First, you have 100% control over your spending. So the first thing you can do to improve the situation is to spend less than you anticipated and stop inflation adjustments for a few years. Second, save a few years of anticipated expenses in cash that you can draw on during down markets before you consider yourself financially independent, so you're not liquidating stocks. Think of it as a super emergency fund. This cash can supplement any decrease you experience from your investment income engine. Third, instead of an immediate transition into FI, consider a slower transition where you don't completely quit your day job, which will help supplement your expenses until the market recovers. If you've already left your job and are a few years into FI, consider returning full or part-time to the workforce. Therefore, it would be prudent to maintain any licenses, continuing education, or skills that you previously used for at least a decade after achieving FI. Fourth, before starting FI, consider getting your feet wet with other low-risk passive income opportunities that can offset any lost income due to down markets. By becoming flexible and willing to move with the market, you'll have more control and peace of mind over the stability of your financial independence. All right, so that's the end of Chapter 8, Investing. I know it was a lot of information. You'll probably have to review this chapter multiple times. And like I said, you can go to barclayroper.com and you can get more detailed information on how to make some of these calculations work for you. So in ending, we have the next steps. I need you to believe every dollar I invest today is a soldier fighting for my financial independence. Examine, do I know how to review my investments to make certain that they align with my financial independence goals? If not, what do I need to do, or what do I need to learn how to do? Act. Take action today by reviewing your investment portfolio. Adjust your asset allocation to align with your required rate of return and ensure that it supports your financial independence goals. Fantastic. Thanks for being with me. I'm Dr. Roper, and this was Chapter 8, Investing, from Liberate, Your Journey to Lasting Financial Independence. We'll see you, stick with me. We'll see you in Chapter 9, Accelerators, so that'll be exciting. Talk to you soon.